Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, December 15th, 2023. The big surprise on Wall Street this week was not the Fed's decision to leave its policy rate unchanged. That was widely expected and already priced into the stock and bond markets. However, Fed Chair Jerome Powell's dovish comments during the press conference following that decision were unexpected and ignited a rally in the stock and bond markets. Without saying as much, Powell insinuated that the current round of rate hikes is over, barring a resurgence of inflation. He also made clear his desire to allow the financial markets enough time to find equilibrium now that inflation, employment, and economic growth are all close to where he would like to see them. Wall Street weighed in by pushing the Dow Jones Industrial Average up to an all-time high that same day. And I'm showing you a chart here of the Dow Jones Industrial Average year to date, and you see the big rise over here on the right, starting basically at the end of October. By the way, if we push back to 5 years, you can see that, well, actually this needs to go out further. And if we go out to the max, you can still see the Dow, again, push it over to the right here, is at its all-time high. Now, that's not true of the S&P 500, although it's close. But nevertheless, Dow reached an all-time high the same day that Jerome Powell made those comments. But the bond market didn't waste much time either. The yield on the 10-year Treasury note fell below 4% the next morning, the lowest it has been since fears of recession pulled down bond yields over the summer. So now I'm going to show you a chart of the 10-year Treasury note. Again, here we are year to date, and way over on the right, you can see it dropping. If we just look at the last 3 months, see it peaking also in October, and then the decline. And if we strip, pan back out to 5 years, it's not as low as it was back before the coronavirus pandemic, but it's heading in that direction. Now that there's an increasing likelihood that the Fed will start cutting its policy rate in 2024 to avoid triggering a recession, it has bond yields on the decline. So they're expecting a rate cut. Some people are saying perhaps as early as March. Powell has been very careful not to commit himself, but that's the current thinking right now on Wall Street. Now that supposition was confirmed by the CBO Volatility Index, or Fear Index, which is at its lowest level since the onset of the coronavirus pandemic nearly 4 years ago. So first I'm going to go back out 5 years, and you can see the big spike in the VIX over here, which of course was around March of 2020. And now if we look year to date, you can see at least this year it peaked also coincidentally back in March. But particularly if we look back now just the past 3 months, you can just see it now falling. And if we look over the past 5 years, pretty close to the lowest it's been at any time over the past 5 years. If the professional portfolio managers on Wall Street felt that a recession was imminent, the VIX would be heading up instead of down. Remember, the lower VIX, the less fear, meaning the less likely portfolio managers think that a stock market correction is imminent. Now, if you're wondering where all the money is coming from to bid up stocks and bonds in the United States, look no further than China. After peaking above 18,000 on November 15th, the Hang Seng Index, China's equivalent of the Dow Jones Industrial Average, fell below 16,000 at the start of this week. So here's the Hang Seng, and this is year to date. And you can just see it, since peaking back early in the year, it's just been on a steady fall. And that works out to a decline of more than 11% in less than a month. Over the same span, the S&P 500 index, the Dow Jones Industrial Average gained 4%. And since the start of this year, the Dow is up 12%, while the Hang Seng has lost 15%. That discrepancy in performance reflects the degree to which investors believe the United States is doing a better job of managing its economy than China. And by the way, this is not a recent phenomenon. Over the past 5 years, and I'm going to show you the Hang Seng over the past 5 years, and you can see Hang Seng is down 35%, while the Dow Jones Industrial Average over the past 5 years is up 54%. So a huge discrepancy in performance. Despite all the complaining about our economy, the fact of the matter is that it's performing far better than its peers in the industrialized world. That is why I've made some changes to our model portfolio, as explained on page 2 of the new issue of Personal Finance published to the website today. That's today's update, and I look forward to talking to you next week. Thank you.